Hi everyone, it's Andrew from Dividend Growth Masters. It's been a while since I made a new video, so I thought I would take the time today to bang out a few videos. And the topic I want to talk about today with regards to dividend investing is diversification. Now, keeping a diversified stock portfolio is very important to dividend investing, and I remember learning about this in college. In school, especially finance schools, they teach you formulas to determine the right allocations and weightings for your portfolio. However, personal finance typically isn't so rigid and black and white. So I wanted to delve a little bit deeper into portfolio diversification and how I actually do it for my own dividend portfolio. So let's talk about why portfolio diversification is needed first. It's a very important part of building a passive income portfolio. A well-diversified portfolio will help keep you from going under when the markets tank during recession. And it's also an effective way to mitigate risk. Now let's talk about the three factors that actually determine portfolio diversification. The first one is age. Obviously, the younger you are, the more risk you should take, and the older you are, the less risk you should take. The second thing to consider is living expenses and obligations. Obviously, the higher your living expenses and the more obligations you have, such as mortgages, taking care of kids, paying for college, that sort of stuff, the more diversification you should have. And the third one, and this is more of a personal evaluation, but it's tolerance of risk. And it's very subjective, obviously. So it's kind of like asking what your pain threshold is. With that being said, everybody obviously has a different tolerance of risk, and that's up to you to figure it out. Personally, I think I have a little bit more risk tolerance than most other dividend investors, but that's just me personally. Alright, so let's get into the actual rules of portfolio diversification. And this is actually the number one rule that I follow myself. And it's one question I ask myself pretty much every time I look at my portfolio when I'm rebalancing it and everything and just looking at the returns. And it's, can I sleep at night? I know it's a simple question to ask yourself, but it's very, very helpful. If you can sleep soundly at night, your portfolio allocation is just fine. However, if you can't sleep at night and you're tossing and turning and throughout the day you're checking the stock price continually and just thinking about a particular stock, then you need to reduce that position as soon as possible. And I've had this before where I would be heavily invested in one stock and I would check it pretty much religiously. Every day when the market opened, I would check it. I would check it throughout the day while I'm eating lunch, running errands, and that kind of stuff. And that's not really healthy. So ask yourself if you can sleep at night. And yes, these days I actually do sleep like a baby at night. Second thing to consider is diversification is more of an art than a science. In general, you don't want to have too small positions on your portfolio because what's the point of having a 0.2% or 0.5% allocation? Even if you doubled on that one position, it wouldn't really impact your life at all. At that point, you would be better off holding a stock index. And at the end of the spectrum, you don't want to own 15%, have a 50% weighting in just one stock and have it, tank by 50%. In that case, your portfolio would have declined 7.5%, which is obviously a lot. So the diversification is more of an art. It's a constant juggling act. And you have to remember that your concept of a properly diversified portfolio will change as you age. So obviously, when you're 25 years old, you might take more risks than when you're 35 or 40 now. Alright, the third thing to consider is your large positions. So these should be the ones you like the most. And when I say like, I mean these have the best risk-reward profiles. So you want to put your money where your mouth is. And the fourth one is something I actually read in a blog post a while ago. I forgot who it was from, but it really stuck with me. And so one of the things you should obviously do as a dividend investor is rebalance your portfolio on a regular basis. So most people rebalance their portfolio by selling their stock. But I think a more effective way to do it is actually to buy stock. So let's say you want to reduce, your exposure to the oil and gas industry. Well, instead of selling your stocks in that one industry, you could actually buy stocks in other industries to kind of reduce the amount of exposure to oil and gas. Now, this is a little bit more of a tax friendly way to rebalance your portfolio, because obviously if you sell a stock and you have a capital gain on it, you're gonna have to pay taxes. And the final thing to consider is that your portfolio should have some cash. Most people actually don't consider cash as part of their portfolio, but I do. And I think the number one reason why is because cash really doesn't earn much in interest rates. But in my opinion, cash is one of the most underrated investments of all time. Cash represents dry powder. So when the stock market crashes, or a particular stock industry crashes, most people always wish they had, extra money on hand to buy great companies. How many times did you hear, oh, if I only invested at the bottom in 2008, I'd be retired now. So no matter what, you should never be 100% invested in stocks at all time, even with your dividend portfolio. So keep in mind, just have some cash set aside so you can buy during dips. Alright, so these are some of the 5 portfolio diversification rules that I wanted to discuss today. As a reminder, you can definitely get some more information about dividend investing through my website, dividendgrowthmasters.com. I also have a free newsletter where you'll learn a lot more in-depth concepts of dividend investing. And if you're interested, I also have several online courses about dividend investing and financial analysis. I'll include links in the description below so you can check that out. And if you liked the video, be sure to hit subscribe. See you next time.